It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, the debt ceiling deadline. At the time of this writing, Congress was still attempting to work through the numerous issues on its plate, namely the raising of the country's debt ceiling, which could have significant market implications should a resolution not be reached soon. The Treasury Department has made it clear that its ability to meet the nation's obligations will run out in October, and despite the potential implications for a U.S. default, albeit unlikely, Republicans and Democrats can't seem to come to an agreement. Republicans seem uninterested in supporting a debt ceiling increase or suspension, while Democrats are insisting that they will do so only with bipartisan support. As we've seen in the past, these battles can have serious market implications, and in 2011 even led to the U.S. losing its coveted AAA credit rating from Standard & Poor's. Congress has never before failed to raise the debt ceiling, and we expect lawmakers to find a way to maintain this record, but as the deadline approaches, markets are likely to see volatility continue to increase. Number 2, earnings season. With the third quarter now in the rearview mirror and no Fed meeting until November, earnings season will likely be a big driver of market action in October. Wall Street estimates third quarter earnings growth of 29.4%, with all 11 economic sectors expected to show growth as companies still face relatively easy year-ago comparisons when much of the country was still facing some sort of COVID-related restriction. The energy and materials sectors will likely post the highest earnings growth rates for the quarter. Looking at the S&P 500, earnings estimates for the third quarter have been revised marginally lower since the start of the quarter, with 5 of the 11 economic sectors having earnings estimates lowered. The industrial sector has experienced the largest downward revision at 8.4%, followed by the consumer discretionary sector, who has seen earnings estimates lowered by 2.6%, while the energy sector has seen the largest upward revision of 6%. The big story as we make our way through earnings season is likely to be margins and management commentary as it pertains to the effects of rising costs on companies as margins sit near record levels. Number 3, natural gas prices on the rise. Natural gas prices in Europe and Asia have more than tripled so far in 2021, which has caused some manufacturers to cut activity and more importantly is sparking power crises in some countries. While the United States, being the world's largest natural gas producer, has been mostly shielded from the sharp rise in prices thus far, they are to some extent beginning to rise domestically, which could indicate that the energy bills causing headaches in Europe and Asia are coming to the U.S. Despite no shortage of supply, the benchmark U.S. natural gas contract has now hit a 7-year high. At $5.62 per British thermal unit, the domestic price remains well shy of the more than $30 per British thermal unit being paid across much of Europe and Asia. As the economy accelerates following the post-pandemic reopening, so does increased demand for pipeline gas, and supply has yet to catch up after pandemic low demand. The United States likely has ample supply and storage for the winter. However, pipeline constraints and competition for expensive liquid natural gas exports were expected to boost prices to multi-year highs in California and New England this winter. And that's been your Market Minute for the month of October. Thanks for listening.